Hello everyone, you're very welcome back to the channel. Today we're going to be answering the question, what are the best synthetic ETFs for European investors? We're going to look at the best synthetic ETFs for investing in the S&P 500, European companies, the emerging markets, and finally the global equity markets as a whole. For each ETF, I'll highlight the fees charged by the ETF, the ETF's domicile, the ETF's dividend status, and the European brokerage platforms that the ETF is available on. If after watching this video you want to get started investing in synthetic ETFs but you don't have a brokerage account, you can try out brokers like DEGIRO, BookZero, Trade Republic, or Trading 212 using the links in the video description. If you want to learn which of these brokers is the best for European investors, check out the video popping up on screen after this one. I do want to mention before we begin that I have a full video on synthetic ETFs where I explain all of the intricacies behind their operation, the pros and cons of synthetic ETFs, as well as synthetic ETF performance data. That video will tell you everything you need to know about synthetic ETFs, and for that reason, I'm not going to be going into too much explanatory detail in this video. If you're unsure about how synthetic ETFs work, I would highly recommend checking out that video first and then come back to this video once you've done that. Alright, so let's kick things off with synthetic S&P 500 ETFs. Synthetic S&P 500 ETFs have one very clear advantage over physical S&P 500 ETFs. They earn 15% more dividends. When US companies pay dividends to physical S&P 500 ETFs that are domiciled in Ireland, they're required to withhold 15% of the value of the dividend and pay this over to the IRS. This is known as dividend withholding tax. However, Section 871M of the US Internal Revenue Code explicitly exempts swaps which provide the total return of a qualified index from US dividend withholding tax. Given that synthetic S&P 500 ETFs use total return swaps to provide their investors with the return of the S&P 500 index, the exemption applies, and thus synthetic S&P 500 ETFs earn 15% more dividends than their physical counterparts. This also means that synthetic S&P 500 ETFs provide a more accurate return which better reflects the S&P 500 index. As a general rule of thumb, whenever US companies comprise a significant portion of the underlying index which an ETF is providing exposure to, it's worthwhile considering synthetic ETFs over physical ETFs, because again, the tax advantage of synthetic ETFs could very well have a positive material impact on returns. With that being said, the first synthetic S&P 500 ETF I want to discuss is the Invesco S&P 500 UCITS ETF, ticker symbol SPXS. The ISIN for this ETF is IE00B3YCGJ38. Investing in this ETF comes at two separate costs: an ongoing charge of 0.05% or 5 basis points and a swap fee of 0.04% or 4 basis points. This implies a total expense ratio of 9 basis points or 0.09% when these two fees are added together. If you were to look at physical S&P 500 ETFs, you'll find that you can invest in the likes of the Xtrackers S&P 500 UCITS ETF 4C, which has a total expense ratio of 0.06% or 6 basis points. On that basis, you might conclude that the Xtrackers fund is cheaper and therefore offers better value. Not necessarily. Remember, the Invesco ETF will be earning 15% more dividends than the Xtrackers ETF. So you need to weigh the tax advantage of the Invesco ETF against the lower total expense ratio of the Xtrackers ETF. It's also worthwhile noting that the performance of synthetic ETFs is influenced by two factors which are less than transparent: swap spreads and additional fund revenues. Swap spreads can either have a positive or negative influence on synthetic ETF returns, whereas additional fund revenues are positive for synthetic ETF returns. Both of these factors change year over year, and whether or not they net to an additional positive or negative return for the ETF is subject to change. Long story short, it's not as easy as just comparing total expense ratios between synthetic ETFs and physical ETFs. There are more factors to consider. SPXS is domiciled in Ireland, it's an accumulating ETF, and it's available on DEGIRO, BookZero, Trade Republic, and Trading 212. However, as we discussed in the synthetic ETF video, your research doesn't stop there. At a minimum, you want to find out A, the synthetic ETF's counterparties, and B, the composition of the collateral basket. Fortunately, Invesco is quite forthcoming with this information. Per the Invesco website, we can see that Goldman Sachs, Morgan Stanley, JP Morgan, Citigroup, Societe Generale, and Barclays are counterparties to the synthetic ETF. Invesco is independent of these counterparties, which limits the risk of under-collateralization, which is typically associated with swap agreements where the synthetic ETF and the counterparty are in some way affiliated. As for the collateral basket itself, what's most important is whether or not the holdings align with your personal attitude towards and tolerance for risk. Ideally, the risk and return profile of the collateral basket should somewhat align with the risk and return profile of the index. We can see that the largest holdings in the Invesco collateral basket consist of multi-billion-dollar companies, many of whom are S&P 500 companies. You'd be worried if the collateral basket consisted of meme stocks or cryptocurrencies. Given that the collateral basket does not exactly replicate the S&P 500 index, its risk and return profile is going to be different from that of the index. In fact, the collateral basket contains companies that aren't even in the S&P 500. Researching and assessing the quality of the collateral basket is not only of critical importance, but it's also a highly personal exercise, because what might be an acceptable collateral basket for one individual might be an excessively risky basket for another. The second synthetic S&P 500 ETF I want to mention is the iShares S&P 500 Swap UCITS ETF, ticker symbol I500. The ISIN for this ETF is IE00BMTX1Y45. The fact sheet for this ETF states that the total expense ratio is 0.07 or 7 basis points. On the website, there is a note which states that the weighted average swap fee is 1.77 basis points or 0.0177%. The weighted average figure is used because the ETF holds multiple total return swaps with various counterparties at different swap fees. iShares indicates that the weighted average swap fee can fluctuate over time. For simplicity, we can assume that the actual total expense ratio accounting for the swap fee is 0.09% or 9 basis points, the same as the Invesco ETF. I500 is domiciled in Ireland, it's an accumulating ETF, and it's available on DeGiro and Trade Republic, but not Book Zero or Trading 212. iShares doesn't disclose the counterparties to the total return swaps on the website. However, upon inspection of the financial statements, I found that Citibank and JP Morgan are the two counterparties to the total return swaps. JP Morgan does have an ownership interest in Blackrock, who is the investment manager of the iShares ETFs, so there could be a conflict of interest issue, particularly around minimum collateralization requirements. This is an important consideration because 69.5% of the counterparty exposure lies with JP Morgan. Unlike the counterparties, the collateral basket is disclosed on the iShares website. If we put the iShares basket alongside the Invesco basket, you can see right away that they're very different. This highlights the importance of evaluating the composition of the collateral basket. Despite the fact that both synthetic ETFs provide exposure to the S&P 500 index, their collateral baskets are materially different, meaning a big part of any investment decision between these two ETFs will come down to whether the investor prefers the Invesco collateral basket or the iShares collateral basket. In the event of a counterparty failure, these are the assets that the fund will have access to, so getting comfort over them is very important. Next up, we have synthetic Europe ETFs. Now, obviously, because there's no exposure to American companies, synthetic Europe ETFs won't benefit from the exemption from US dividend withholding tax. However, there are still tax advantages. Synthetic Europe ETFs investing in UK companies save money on stamp duty, and synthetic Europe ETFs investing in French and Italian companies save money on financial transaction tax, or FTT. Stamp duty is charged at a rate of 0.5% in the UK, while FTT in France and Italy is 0.3% and 0.1% respectively. So, synthetic Europe ETFs, unlike physical Europe ETFs, are gaining exposure to these companies without having to pay the aforementioned taxes, thereby improving returns for investors. The first synthetic Europe ETF I want to discuss is the Invesco Stocks Europe 600 UCITS ETF, ticker symbol SC0C. The ISIN for this ETF is IE00B60SWW18. Per the fact sheet, there is an ongoing charge of 0.19% or 19 basis basis points and a swap fee of 0.33% or 33 basis points. This represents a total expense ratio of 0.52% or 52 basis points. This expense ratio is quite high relative to the physical Europe ETFs that are available. While UK companies account for over 20% of the ETF and French companies account for over 17%, the tax advantage likely wouldn't outweigh the higher total expense ratio associated with the synthetic ETF. SC0C is domiciled in Ireland, it's an accumulating ETF, and it's available on DEGIRO, Book0 and Trade Republic, but not trading 212. As per Invesco's website, the swap counterparties are Societe Generale, Morgan Stanley, JP Morgan and Goldman Sachs. The second synthetic Europe ETF is the Invesco MSCI Europe UCITS ETF, ticker symbol SC0E. The ISIN for this ETF is IE00B60SWY32. Unlike the previous two Invesco ETFs, this ETF has no swap fee. There's a flat ongoing charge of 0.19% or 19 basis points, which on paper makes it much more attractive than the Invesco Stocks Europe 600 UCITS ETF. SC0E is domiciled in Ireland, it's an accumulating ETF, and it's available on DEGIRO and Trade Republic, but not Book0 or Trading 212. As per Invesco's website, the swap counterparties are Goldman Sachs, Societe Generale, Morgan Stanley and JP Morgan. Once again, if we compare the collateral baskets of both ETFs side by side, we can see that they're very different. Next up, we have synthetic emerging market ETFs. The primary benefit of synthetic emerging market ETFs is the fact that they can provide better tracking accuracy to the underlying index as compared to physical emerging market ETFs. Long story short, due to the size of the emerging markets and the number of companies, physically owning every stock in the index in the exact same proportions as the index can be challenging and costly. As a result, many physical emerging market ETFs use optimized sampling strategies to provide the index returns, which can increase tracking errors for better or worse. Synthetic ETFs don't have this problem because they artificially provide exposure to the index. Therefore, in theory, synthetic ETFs should provide investors with a more accurate index return. The first synthetic emerging markets ETF I want to discuss is the Invesco MSCI Emerging Markets UCITS ETF, ticker symbol MXFS. The ISIN for this ETF is IE00B3DWVS88. Per the fact sheet, there is an ongoing charge of 0.19% or 19 basis points and a swap fee of 0.10% or 10 basis points, giving a total expense ratio of 0.29% or 29 basis points. MXFS is domiciled in Ireland, it's an accumulating ETF, and it's available on DEGIRO, Trade Republic and Trading 212, but not Book0. As per Invesco's website, the swap counterparties are Goldman Sachs, JP Morgan, Societe Generale and Morgan Stanley. Note how the collateral basket is primarily made up of US companies despite being an emerging markets ETF. A great example of how the risk and return profile of the collateral basket can be very different to that of the underlying index. The second synthetic emerging markets ETF is the Lyxor MSCI Emerging Markets Lux UCITS ETF accumulating, ticker symbol LEMA. The ISIN for this ETF is LU22001462228. Per the fact sheet, there is an ongoing charge of 0.14% or 14 basis points with no disclosed swap fee. LEMA is domiciled in Luxembourg and it's an accumulating ETF, but it doesn't seem to be available on DEGIRO, Book0, Trade Republic or Trading 212. However, its distributing counterpart, ticker symbol E127, is available on DEGIRO. As per the fund financial statements, Merrill Lynch is the only counterparty to the total return swap. The collateral basket for the Lyxor fund is materially different to the collateral basket of the Invesco fund. Last but not least, we have synthetic all-world ETFs, or rather ETF, considering there is only one competitive option. Given that all-world ETFs provide exposure to global equities, all of the tax benefits associated with synthetic S&P 500 and Europe ETFs will also apply to synthetic all-world ETFs. The ETF in question is the Invesco MSCI World UCITS ETF, ticker symbol MXWS. The ISIN for this ETF is IE00B60SX394. Per the fact sheet, there is an ongoing charge of 0.19% or 19 basis points with no swap fee. MXWS is domiciled in Ireland, it's an accumulating ETF, and it's available on DEGIRO, Trade Republic and Trading 212 212, but not book 0. As per Invesco's website, the swap counterparties are JP Morgan, Morgan Stanley, Societe Generale, Citigroup, and Goldman Sachs. The collateral basket is predominantly made up of US companies. So those are some of the best synthetic ETFs for European investors. Now that you're in the know, you might want to get started with investing. Again, if you don't have a brokerage account or you want to try out a new broker, you can sign up to DeGiro, Book0, Trade Republic, or Trading 212 using the links in the video description. Using these links supports me as a creator and lets me know that you found this video to be useful. What synthetic ETFs do you think are best for European investors? Have I missed any contenders that should have been included? If so, let me know in the comments. If you're interested in learning more about synthetic ETFs, you should definitely check out this next video if you haven't already. Thanks very much for watching, and I'll see you soon.